afternoon. Happy Thursday. This is Sean LaBelle of the Dekker Hewett Group. We closed out the first half of 2022 on a negative note this week, with all major indices finishing in the red. For reference, this has been the worst first half of the year in the S&P 500, which again is the most broadest sense of the market since 1962. So we haven't been understating the weakness in the market the last several months. It has truly been historic. Nothing really in particular moving markets lower this week, which has been unfortunate after the failed rally that we did see quite nicely last week. Moving markets a little bit on Friday was actually a better than expected inflation data, though, that came out of the United States. This is core CPI. It actually rolled over a little bit for the month of May. We were looking for a reading of 4.8%. It came in at 4.7%. So while this is still high from a historical perspective, it is speaking to that point that we've been talking about, that inflation likely has peaked and we should start to see it roll over. And why this is important is it just means the U.S. Federal Reserve and other central banks around the world might be able to take their foot off the pedal when it comes to these interest rate hikes in order to combat inflation. That's really been driving markets lower, is just the very aggressive rate or pace in which these central banks increase interest rates. These are near also historical rate increases that we are seeing out of these central banks. So it's a bit of a reassuring data that we did see on Friday. It didn't do much just yet for markets. But in terms of this week's Market Watch Weekly, we just once again talked to the state of the economy in the United States. There's a lot of talk around potential recessionary environment. The U.S. is not in a recession at the moment. The data just simply doesn't back it up. The economy is actually still running quite well. So we just talked to that a little bit. Along with prior corrections, we have seen four very abrupt ones so far in the last 12 years. So there's an interesting, four interesting tables in there rather, that just run through the historical performance of the market 1 through 5 years following these periods of corrections. And it speaks to our message that the fact that the market always bounces back and bounces back quite aggressively. You want to be buying these dips, as painful and as counterintuitive as it might seem. It does generally pay off for investors in time. It's just a matter of how much time. We'll end it there. Hope everyone enjoys the Canada Day long weekend, and we will talk to you again next week. Cheers.